Yesterday we had our pre-meeting, half an hour of discussion within the five of us, and it was interesting to note that we were able to reach some conclusions, but still we have different ideas when you go to be pragmatic in application of financial reporting. Because financial reporting means who is reporting, what is reporting, to whom is reporting, what's the environment. So it is like trying to give the definition of public interest. Probably there are millions of different public interests, and therefore we may need the difficulty of solving all the problems today, but at least in 1 hour and a half, we are trying to give you possible insights to go back to your countries and having, something more to think about. So, but firstly, let's try to focus on the main item, which is IFRS for SMEs. You know that IFRS for SMEs has been introduced in several countries, translated into different languages, and this probably means that there has been solutions also in translation, because sometimes the language barrier is a big problem. Maybe you have been also involved. I know in the SME implementation group you have been discussing sometimes difficulties in translations. And there are jurisdictions like Europe as a whole that somehow say, oh, we don't like it, IFRS for SMEs. So we'll try to see if different jurisdictions can give to accountants and to SMEs solution or point of discussion that can solve also problems that sometimes are more political than technical. So let's start with Daryl and try to figure out what about with IFRS for SMEs.
Thanks, Federico. I think, as you've alluded to, IFRS for SMEs is written for a very specific market. At the top end of the financial reporting space, we have public companies, public interest companies, companies that are listed, and full IFRS is written specifically to address that space. At the bottom end of the financial reporting market, we have the very, very small companies, the minute companies that don't actually need general purpose financial statements at all. IFRS for SMEs is addressed to the middle of that space, the companies that do need general purpose financial statements, that are reporting to creditors, that are reporting to their finances, that may even be reporting to their family investors and other investors. So they need some type of framework. And when the board sat down, when we sat down and wrote IFRS for SMEs, we were looking to target that specific area, and we believed there was a need for a reporting framework in that space. We heard a lot of people talk to us about whether or not it was necessary for that reporting framework to be consistent, and we felt it was very important that creditors and investors, when they pick up these small financial statements, understand the need for consistency and address the need for consistency. We also asked a lot of questions about whether it was necessary for there to be an international standard. And I think what we realized in the process of developing the standard, that there's an awful lot of cross-border trade that happens, an awful lot of international financing and international investment that happens. And so we felt that building a standard that fitted into the space, that was international and that allowed for consistent reporting across the board, would be a useful addition to the process. I think we've seen that in the take-up, and as you alluded to when you spoke earlier, you mentioned that there are a lot of companies that fill this space. So if we were measuring the uptake of IFRS for SMEs based on the number of companies that use it, we would probably very quickly conclude that it was much more successful than full IFRS. And that's because there are actually a lot more companies in this space. So the uptake, there are vastly more companies using IFRS for SMEs today than there are companies using full IFRS. That's simply the nature of the market, though, that's simply the nature of the volumes involved in this space. At the ISB, when we looked at this, though, we tried to look at it from a jurisdiction perspective. And what we've seen from a jurisdiction perspective is that and in the past we've said about 80 countries, we've now gone more formal and measured that, and we come to the conclusion on the basis of 138 countries that have talked back to us, or have come back to us, that there are 69 jurisdictions that use IFRS for SMEs pretty much as written, and there are another 17 countries that are in the process of evaluating whether they want to adopt it. So call it 86 countries that are in this space. Now that contrasts to 113 countries that use full IFRS. So to your point, certainly not the same level of adoption at a country space that we see for full IFRS. But there are reasons for that, and perhaps we'll get into those later on in the discussion.
Right. Thanks a lot, Darrell. Before we go deeper into the discussion on how in single jurisdiction SME accounting is based. May I ask quickly to the three panelists, different from the standard setter, can you talk quickly about the status of adoption of IFRS? And then we go into how better do it.
Sure.
Mark.
Thank you, Federico. Yes, in the U.S., we have not adopted IFRS for SMEs, and one of the challenges is we haven't adopted IFRS, so we're still under U.S. GAAP, and that isn't going to change in the near future, but we are encouraged by the naming of a new chief accountant for the SEC, and James Schnur, that he has interest in at least trying to settle the debate over IFRS or US GAAP. So until that happens, I think it would be incredibly challenging for us to have something for the smaller company. We do have other private company options. Not every company is the same, and to Daryl's point, I think it's important that for small private companies, they have a differential option. And in the US, for the longest time, we didn't have that up until about 2 years ago, when we really worked hard with the FASB to create an alternative. And they've created the Private Company Council through the FAF, the overseer of FASB. And we've also created a framework that is for what we would call even a micro entity beyond that. Because even in the private company space, you're going to have different needs. And the needs aren't necessarily always up to us. Yes, we're the financial experts, but it's going to be driven by the marketplace. And we've seen in our market that the creditors, the banks, is number one reason why they need accounts in a financial statement, that they started to rely more heavily on a tax return for the smallest of entities because that financial statement was too complicated and too cumbersome for the small business. So we really had to react to that and come up with an option that was better.
Thanks. Peter, what about Australia?
Well, in Australia, we start from the premise that a private company is just that, it's private. So for the past 20 years, we've had quite a relatively stable regime where the carve-out for private companies to get into the IFRS filing accounts with the regulator has been determined by essentially the public interest or the dependent user, a public interest or dependent user test. So if you satisfy that test, which we can speak about later, then you have to file accounts with the regulator. But at CPA Australia, we're pretty happy with the system at the moment, which effectively results in about 98% of private companies, SMEs, not filing accounts with the regulator and therefore not being in that IFRS area. If there's any tension in Australia at the moment around this, it's at the margin. Some of the larger private companies are probably gaming the system a little bit. Some that perhaps should be filing aren't, and some that perhaps don't need to. If there's any look into the future, we'll probably, the pressure will probably be on increasing the threshold for private companies to report their financials to the regulator, which of course means they become public. So it might end up being only 1% of SMEs that report to the regulator, if that's where the tension is at the moment.
Very good. Thank you. Thank you very much. Andrew, you come from the UK, so maybe you want to explain if something specific is happening with regard to IFRS. You are representing the only European country within this discussion.
Thank you. The UK is in a very interesting position at the moment because we are about to have a very substantial overhaul of our private company reporting. Existing UK GAAP will be eliminated completely, and we'll go on to a new tiered system of financial reporting that's intended to be proportionate in that the financial reporting burden that is placed on companies of different sizes is going to be of a differing level of complexity. Because we are a country within the EU, our listed companies need to produce financial statements in accordance with EU-endorsed IFRS. That is an option which is available to private companies as well. They can do that. And there was, at one stage, a suggestion that perhaps everyone should just do IFRS and we're finished. But it was felt that that was too complex. So instead, what we will have for 2015 is a new standard for small and medium-sized entities, although it will extend up to very large private companies, that we'll call Financial Reporting Standard 102, but is in fact the IFRS for SMEs, with a number of amendments that have been made to it, partly to comply with the law, and partly to introduce one or two options that don't exist at the moment in the IFRS for SMEs. And we might come back to these a little bit later on when we look at it. In addition to that, for companies which are subsidiaries of parent companies that produce consolidated IFRS financial statements, there's another regime being introduced. That is IFRS numbers, but with reduced disclosures. And then down at the bottom for very small companies, and by that I mean companies that for European legislative purposes would qualify as being small. So at the moment, say turnover less than around 6 million euros or thereabouts, but that limit's going to go up. There's another reporting standard which has very simple requirements that we call the Financial Reporting Standard for Small Entities. So what we'll have is something where the IFRS for SMEs will come in and will cover the financial reporting for a very large proportion of private companies in the UK.
Thank you very much. So we have now set the scene somehow, probably a little bit still in the theory, with some input with regard to what's happening. And I like to see if we can go deeper into the single jurisdiction and into the philosophy of the standard setter, if this can help companies and accountants to better apply the standard. Now, picking from the experience we had in Europe quite recently with the reform of the fourth directive, and given the fact that in Europe, all limited liability companies are subject to compulsory financial reporting and filing because of the interest of creditors and the public interest, which is not the same necessarily in other jurisdictions, we had a particularly interesting and spicy, I would say, discussion, both from the technical and political point of view, on how to reform the directive and how to simplify. Now, the question of simplification is sometimes tricky because if you consider that when you account for what's happening in your company, you have in any case to translate into lines and numbers all the transactions up to the end of the year. And then you produce a final financial statement and then you publish in a certain way. So when you simplify, do you mean that you may choose which kind of transaction you want to record or not, which is not the deal. Absolutely, you have to record everything. So how can you simplify? So we had this discussion in Europe to simplify, and then we discovered that politicians were ready to say that simplification was, okay, well, you publish a couple of lines rather than 20 lines, and you save money. So we had a discussion on the relevance of what you were publishing and showing to the public, which in my view is implying exactly the question and the answer to whom am I reporting and what am I reporting to satisfy the needs, both myself as willing to report and others reading my statement. So the question of relevance was raised by the accounting profession in Europe during the discussion. I have been chief executive of EFA, the European Federation of Accountants and Auditors for SMEs, and I remember we came out with a strong paper discussing with the Commission why they wanted to simplify in terms of reducing the information rather than considering what was relevant to be reported. So based on the fact that you should be pragmatic and help people to do exactly what they need, I would like to ask to all of you, starting from the standard setter point of view, have you considered relevance as a point of, when producing IFRS or IFRS for SMEs, relevance as something that is linked to simplification, or relevance is something that is per se? And that, Gerald.
So I think the challenge in getting into that space is that relevance is one of those things that's a little bit like it's in the eye of the beholder. When we start out on any standard setting process, one of the first things we like to consider from a standard setter perspective is who is going to be using these financial statements, and to what extent is the information they're going to be using relevant to the task they want to perform. So when I look at an SME, generally speaking, the primary users of an SME financial statements are creditors, they're bankers, and they might be to a lesser extent investors. But for them, the relevance is what is the future performance of the entity likely to be? And so when we think about it, when we draw up a set of accounting standards, our primary objective is to focus on that element of relevance. How will that information be used? That drives things like trying to eliminate as many options as possible. A user of financial statements doesn't want to have to constantly adjust and read further and understand more to understand what's happening. They'd like everything to be based on a consistent starting point, a consistent calculation basis. Now, obviously, anybody who's going to be advancing credit to an SME, anybody who wants to invest in an SME, is going to dig further. They're going to actually get more information. But if they have a common, solid foundation, that's the most important part. So from a standard setter perspective, when we try to define what relevance means and how we translate relevance into simplicity, we start by saying, what does the user want? And how can we limit the number of options for the user? Because simplicity in the eyes of the user is about having as few options as possible. There is an element of contradiction there, though. And when I say it's in the eyes of the beholder, this is where it comes in. From a preparer perspective, I want as few different versions of numbers wandering around. So I don't want to prepare something for my internal accounting and something different for the tax man and a third different thing for outside users. I don't want 3 sets of books that I'm running with. And so very often when you talk to preparers, one of their primary drivers is to have as many options as possible to try to accommodate the way they think about the business themselves, to try and help them tell the story. And so from a standard setter perspective, the contradiction that we constantly deal with is how many options can we introduce into the process without making the user role complicated. When Andrew was talking earlier about what has happened in the UK, he mentioned that specifically the UK, in addressing this problem, in achieving that balance between complexity for user and complexity for preparer, has chosen to introduce a few more options. And in some ways, that's because the UK market is one that has had a lot more experience with standard setting and a lot more experience in dealing with these differences and dealing with these options than perhaps some other markets have.
Now, we have listened to the standard setter. Mark, what do you think is the approach you're having in the US, which I understand is slightly different, or at least not exactly mirroring the philosopher staying in IFRSs?
Let me start by saying I completely disagree with the standard setter. No, I'm just kidding.
Well,
There are some differences.
We are here
for
to
sure.
create an argument, so
We
we
had to spice it up a little bit. It was getting a little too tense in the room. So, but looking at the idea of relevance, and Daryl had good points, and it is in the eyes of the beholder. But there are things that we need to do to work through that. In our marketplace, we have watched the marketplace change because of our complexity and the fact that we only had one option for the longest time, and that was US GAAP. And it got to the point, and I was back 2 months ago, I was visiting some banks and creditors, users of financial statements down in the Florida market, and we were talking about our new FRF for SME, our new framework for small businesses. And a credit officer was looking at that and said, you know, we've moved away from a financial statement completely because they've just been too complex and too burdensome on the client. And based on the level of risk, it wasn't absolutely necessary. So we've relied on just obtaining a tax return as the proof of accounts for the particular entity, making the financial statement completely irrelevant in that marketplace. So making the changes that we have, and so it goes back to the fact that US GAAP, we have 14,000 listed entities in the U.S., on the U.S. exchange. We have 29 million small businesses, and we were telling 29 million small businesses that they had to follow the rules of the 14,000, and that just didn't make sense. And so we said the system needed to change. We had worked with FASB. FASB created the Private Company Council. They've made, so far, 3 changes from the standard U.S. GAAP for private companies. But our framework, because of the tax situation, it's kind of progressed over time. So we had a system called Other Comprehensive Basis of Accounting. OCBOA was, we love our acronyms, OCBOA was a way to do a financial statement that wasn't GAAP-based, so it was a non-GAAP option. In many instances, it was based on cash basis or modified cash basis or even income tax basis if they wanted to see the plain paper statement. And when that happens, I could take a client and I could say we're going to do an income tax basis financial statement. I could give that to 5 different firms and get 5 different answers, right? So that's why we created our FRF framework. And we brought in users, we brought in preparers, and we had the audit community, all 3 together to come up with a framework that made the most sense for those micro businesses.
Great. Peter, what about simplification in Australia?
Well, I've mentioned in my introduction that the primary driver in Australia was really the public interest test and the dependent user test. In other words, in the interests of costs of compliance for small business, if there's no public interest or dependent user, we shouldn't be trying to impose compliance requirements on these businesses where there's no general benefit. So in terms of being the peacemaker, I probably sit halfway between these two. It's very interesting to note that the Queensland University of Technology has done a study on people who on the readability or people's ability to understand financial statements, and that obviously includes IFRS compliant financial statements. And surprise, surprise, the great bulk of people don't understand the subtleties of what they're reading in financial statements. So I'd put the position that certainly with SMEs, and even for the larger end of town, we're producing a product at considerable cost that a lot of people don't understand. And as far as a dependent user goes, in Australia at least, in my experience anyway, very few people rely solely on the financial statements. They seek them because they're there and they're available. But if you're a bank, you'll be very interested in the valuation of assets, for example, and a good solid prediction around cash flow. If you're a creditor, you won't be particularly interested in how good will's amortised. You'll be very interested in cash flow and ability and credit references, repayment history. So these users aren't dependent users. They're users that could be said to be using financial statements, but they have other ways of getting that sort of information. And what I'm talking about here is compelling people to use IFRS compliant financial statements and make them public. If a particular business sees a good reason to do that, there's no reason for them not to adopt these standards. They may well regard them as a great template for seeking investors or satisfying creditors, etc. And they can shadow adopt these standards if they wish.
I have an instinctive question because I know you are also director of company, and probably you are one of those directors of companies that are able to understand the financial statement. Do you see a sort of an educational challenge for companies to be able to understand, or when you say they don't understand, you feel you accept it that they don't understand?
Well, I think boards in Australia accept that you need to have 1 or 2 people on a board of, say, 7 that are quite financially literate, and then you need to have the other directors I'd say one or two that are almost in the expert category, and then the others need to have a good financial understanding. We had quite a well-known case in Australia around a property investment company called Centro. Others might have heard of it, and that frightened a lot of directors in Australia because it does, without going into the full details, it imposes obligations on directors to at least have some understanding of what they're signing. And I think you'll find, particularly in the SME market, that there's a lot of lack of knowledge about what directors are signing, to be frank, in terms of the subtleties of the financial statements that they're signing.
Well, I fully agree with you. And
That's a relief.
I personally think that for the profession, this is a bit of a challenge in small companies, because when you help them to prepare the accounts, then you understand that they rely on you signing something that they will not be ready to understand fully. Then you should distinctively say, but this is your product, I'm helping you to prepare. At the same time, maybe you want to explain what they are signing. So in smaller entities, there may be a bit of a challenge. Then we go to Andrew, sorry, but we are changing.
I just think the conversation we've had up to now has actually brought forward a couple of really interesting themes from my perspective. I think in terms of what you were saying, even in a country where you have a single tax system where tax reporting potentially provides a relatively consistent base, there is some demand for something else. I think, Peter, what you were saying is even in Australia, companies are, to a certain extent, self-selecting IFRS for SMEs or some other form of consistent framework to report. I think the difficulty that we're struggling with, the difficulty you had with the fourth directive, the difficulty that each of the jurisdictions has here, is not so much whether we need a framework, but how we choose the companies to whom that framework applies. And it seems like in the US, you've been able to allow a certain element of self-selection to happen there. It seems like in Australia, an element of self-selection is happening there. But I think many countries are battling not so much with the format of what they require, but how they apply it to individual companies, how those companies choose the route. And I think that is perhaps one of the biggest challenges we're dealing with in the space. And then I think, just listening to you earlier, Andrew, when you were talking about the UK and the approach the UK is taking, it seems to me the UK has got quite a sophisticated method for trying to pick the different models for different companies. But even in the UK, I suspect there's a challenge left in that space.
But in fact, can we say that the UK experience is something we can rely on in Europe because you solved the issue?
I always like it when Europe relies on the UK. It's a very good thing to do. Looking at the relevance of financial statements, I come from a jurisdiction where there is a very long history of company financial reporting, both publicly listed and private. And the origins of that come from the need for shareholder, lender, and creditor protection. Now, perhaps you might say shareholder protection isn't quite so relevant in private companies, but lenders and creditors certainly are. Now, while if I'm a bank that's lending to a private company, I can always ask for a great deal more information. The financial statements are quite a good starting point. Creditors are in a slightly different position, and it's interesting that in the UK, it's possible to obtain the financial statements of any company, whether private or public, simply by going to the regulator and asking for them. And the greatest demand for financial statements comes from companies and other entities that want to start trading with companies that already exist. So it seems to me that the demand is there for financial information. In terms of the question of relevance on a slightly wider scale, unlike some jurisdictions in the UK, tax returns are based primarily on the published financial statements. There may be some amendments made to these numbers, but your starting point is the financials. And that means that there is a very important public interest part to this, because you want to ensure that companies are reporting on a consistent basis on a framework which is appropriate. And that then takes me back to one of the earlier points, which is the proportionality of the approach that we've adopted. And part of the consultation where we were looking at making changes to UK GAAP were, if we look at the three main options, we could do full IFRS, we could do something based on the IFRS for SMEs, or we could go and develop all of our own standards. What is going to be the most proportionate? What is going to be cost effective? What will provide the financial information that's needed? And that was why we ended up going down the route that we did, and as others have suggested, concluded that requiring full IFRS for private companies really wasn't a feasible option.
Thank you very much, Andrew. Now, let me move to some other kind of questions that I like to raise, to make hotter, if possible, the discussion. Starting again from the experience we had in Europe, and again, moving forward a little bit on simplification. You know that at the end, Europe said no to IFRS for SMEs. And then we have now the reform of the Fourth Directive, where we incredibly have a fixed layer for micro entities, some kind of options in the medium part of the size of the companies, and then full IFRS for listed companies. So we are harmonized at the bottom, at the very top, and then we have something in the middle, right? So the question for me is, again, why didn't we go for one full set, maybe discuss with ISB how IFRS for SMEs could have been further changed or tailored? And so to try to help maybe other jurisdictions to understand what is the loop, what you're feeling with regard to the true reasons why Europe refused IFRS is, having looked at then at the result we have now in the Fourth Directive.
So I think what we've seen, and this is not just a Europe issue, I'll answer it first in the broader context, and then we can perhaps drill down to the specific Europe issues, is that in jurisdictions where you have an existing long-dated standard-setting process, and Andrew was talking very much about the UK in this sense, and I think it's a good example to use. What you've got is you've got an expectation that the accounting standards that you apply to these small companies will reflect the underlying legal framework, will reflect to an extent the underlying tax framework that exists in those jurisdictions. And the reason behind that is something that I sort of touched on a little bit earlier, is that from a small company perspective, the argument that you want to have an international comparability is not as pervasive. It's not as big an issue for small companies as it is for their bigger compatriots. The argument for small companies that they don't want to have too many sets of books is a more pervasive one. They're less inclined to actually go for different tax accounting to reporting to the external world. So you've got a couple of factors that come into play there. Now, if I ever look at the way the UK dealt with this, was to say, well, they realize they've got a problem, that their existing compliance with the Fourth Directive is not necessarily consistent with IFRS for SMEs. They can't achieve one with the other. They therefore need to look at whether or not IFRS for SMEs should be thrown out completely because it's not fit for purpose in their particular jurisdiction, or alternatively look to whether or not IFRS for SMEs can be amended to achieve something that is fairly similar to the final SME standard, but at the same time accommodate some of those specific jurisdictional and tax and legal aspects of their environment. The difference between particularly the countries in Europe and some of the other countries that we deal with in Australia may well be one in this space, is that because there is a long history of dealing with standard setters or standard setting, there is the framework, there is the resource, there is the capacity to be able to accommodate those additional things, to look to make changes to the underlying standards, and in so doing to accommodate the additional requirements that come with that. So what the UK has done is simply taken IFRS for SMEs, updated it within their own framework, within their own resource base, to produce something that is more or less compatible with IFRS for SMEs, but also specific to their jurisdiction. And they have the resources, they have the ability to do that. Once we go out to the broader world, what you find is that there are many countries who either didn't have pre-existing SME-type guidance or didn't have a national gap that worked really well for smaller companies, and so they were comfortable to take IFRS for SMEs as it stood. It saved them the ongoing effort of having to continuously update the standard for changes in underlying circumstances, and it saves them from having to establish the credibility of whatever new standard they've written within their own jurisdiction. They can use this name, IFRS for SMEs, that's got an international credibility, and use that branding as they go forward. I come to Europe then. I think the specifics of Europe are firstly that the fourth directive does disagree with IFRS for SMEs. Certainly we've had ongoing interaction with the European authorities about whether we should try to amend IFRS for SMEs to be more compatible with the directive. But at the same time, we've got a responsibility to look beyond Europe to all of our constituents. And that means we're in a situation where we have an underlying legal difference between the legal framework within which SMEs operate and IFRS for SMEs. So I think that was the starting point for Europe considering the path it should follow. In addition to that, Europe has got a very strong track record of developing its own standards, and developing its own standards in ways that both accommodate the requirements of users of SMEs, but also accommodate the requirements of the specific jurisdiction they're operating in, the specific country, and sometimes even reflect some of the policy objectives of countries in that particular jurisdiction. And so I think things like that, policy objectives, the specific requirements. I've even heard comments about the specific culture. So in some countries you'll hear them talk about they have a culture of being more conservative or being more prudent in preparing accounts, and they want that culture reflected in the standards they use. Whether you term those political factors or not, I'm not too sure. I think certainly politics is the response to constituent requirements, and the ISB has the difficulty that it operates with a very broad range of constituents, so it's harder for us to be directly responsive to each individual constituent. If you're setting standards in a particular country within Europe, you're more able to be responsive to those requirements. So I think that is a little bit of a political driver of the thought process.
Well, thanks, Gerald, because you have confirmed what was my feeling. So still, as an accountant and a preparer, I would like somebody to answer to my question. Are there only technical difficulties? Can we solve technical difficulties while applying IFRS for SMEs or other standards? So can I understand from the other three speakers, have you addressed and solved technical difficulties to help this specific sector of private companies? Because we know in Europe, we just stopped in front of a bit of laziness, if I may say, and some political issues. So the classic division we had within 28 member states. But you are single, apart from the UK, yes, but UK is somehow single with regard to Europe. So can I have your view on?
So, and just to Daryl's point, and so I'm only going to agree with you this one time. And I liked the thinking of IFRS for SMEs for countries who may not have had some type of framework around what private companies would need. Speaking to many others, and Andrew touched on it with the UK, that with having an established framework outside of IFRS, it was already there. For us, we have an established framework, obviously, since we're not even currently using IFRS, but we have convergence and things are close or closer to IFRS than they've ever been in US GAAP. But you look at France, you look at many of these other countries who have had some established GAAP. When we created our FRF framework, because we've just been in this process that we had the opportunity to just go ahead and adopt IFRS for SMEs, and we respected the IFRS for SMEs, and we brought it into the conversation. And there are elements in there that we probably have incorporated in that. But we did the same, looking at all the other gap features in the other countries, what they're doing for private companies. So we had kind of a blank canvas in which we could draw our art of a financial framework that would make sense and could be adjustable based on the multitude of complexities or differences in small businesses. You can't say that these small businesses can all just use one technical standard that they all then must follow, because they're all going to be very different, and their needs are going to be different, and the creditors' needs are going to be different. So to us, it was important to look at all of that, but to adjust. And I think for the countries who have the standard setting ability, and Australia, the UK being part of that, I think it's important then to recognize the IFRS for SMEs, but still use that within the current framework that they're operating in.
Good. Peter.
We, of course, in Australia, as has been acknowledged, have a long history of complying with have a standard setting process and a regime that complies with those. I suppose in Australia, as the rules become more complex, our love affair with them diminishes. I still think, and I sound like a broken record here, but I still think at the end of the day we have to ask the question of ourselves, who is benefiting from us requiring companies to prepare financial statements? If there is no public benefit or dependent user, I'm not sure what the argument is. If we seek to impose on small business in particular a framework that is costly for them to implement, they don't really understand it and they don't use it, I mean, I do wonder what the point is.
Andrew.
Maybe if I could just pick up on a couple of points that were raised. I think the point of what's the relevance is particularly important, and it filters a little bit into part of the reason I think why Europe hasn't moved. Because if you look at a number of member states within Europe, local GAAP for accounting purposes is in fact tax legislation. And it's very different from the more commercially based accounting standards, certainly that I'm used to. And so to bring in something based on the IFRS for SMEs to Europe would then be to impose a requirement to prepare two sets of financial statements. And that wasn't felt, I think, to be particularly sensible. So that perhaps answers a little bit of that question. On the should you be producing financial statements at all, I think that if you're running a company certainly in my jurisdiction gives the company directors a lot of protection. It allows them to walk away from liabilities. It allows them to walk away from awkward trading positions. And therefore, I think that if you have the ability to do that because of the way that you conduct your business in a legal framework, then there is a reporting obligation so that people can see the effects of the transactions that you've entered into, and then can choose whether they want to trade with you in the future. And that's in very sharp contrast. I think you could have an argument, for example, about partnerships, where partners have unlimited liability for obligations. That's a slightly different place to be.
Darren.
And I agree with everything Andrew said. I've got no. What I did want to pick up on was something that Peter said, because I think it's a valid criticism or valid commentary on full IFRS, that without question full IFRS is complex, it's onerous to comply with. It creates a significant hurdle to adoption because it is a difficult standard to work with, or difficult set of standards to work with. Now, in some ways, like with US GAAP, that's by design. These are big, complex companies that are applying it, which have the resources to apply it. I think if I were to pick up on what Peter was saying about a concern about the complexity and the difficulty of applying IFRS for SMEs, then I think that should be a challenge to us as standard setters, and perhaps that's us, the IFRS, or ISB. It's probably also the individual jurisdictions that are applying these as standards. That we would like to think of IFRS for SMEs as something that is in fact simple and easy and intuitive to understand. Now, sometimes a set of standards like IFRS for SMEs has to make hard decisions, like how you should depreciate or how you should account for financial instruments. But even those hard decisions should provide an answer that can be understood, that can be worked with, that gives a logical framework for the owners of the business to look at and understand their business as much as anything else. And so I think if we're finding that the SME standards, wherever they produced and however they produced, are difficult or complex, that's something we should address. I don't think that should be a hurdle to entry, because I think it's something we must fix rather than saying that it's a necessary requirement of a set of standards. But I do agree with Andrew's point that the difficulty, I think, comes not from how hard or how difficult IFRS for SMEs or any other standard is. It's rather from the fact that if I have to only produce numbers for the taxman, why must I then produce another set of numbers, particularly if no one is going to use those numbers? If they're only going to the taxman and I'm having to produce IFRS for SMEs and then adjust them in order to get to the taxman who's the only person who's using them, there's a double or duplication of effort that I think doesn't make sense. But if I am using my financials for something else, if I'm using my financials for credit or to report back to investors, I think tax accounting is, generally speaking, ill-suited for that. Tax accounting doesn't produce good accounts because the objective of tax accounting is something completely different to the objective of financial accounting.
You want to reply, Ed?
Just one point on the question of jurisdictions that are coming from perhaps no or very little of an accounting framework onto those with an established one. And you might then validly ask the question, well, the UK had established UK GAAP. So why did the UK choose to move? Why did it choose to change? And at least part of the answer to that question is that if you look at old UK GAAP in its last 2 months of existence, it's a patchwork of different requirements. We've got rather old accounting standards developed during the 1970s and 80s, called SAPs, or Standard Statements of Accounting Practice. The next decade was financial reporting standards, which tightened up a lot in accounting requirements. And then once IFRS was coming, there were new IFRSs that were rather based almost word for word on existing IFRSs. And so we had a number of different requirements in place. And because for some companies, not all of some IFRSs were brought in, we sometimes got rather awkward clashes in the requirements. And so what was needed was an updated set of financial reporting standards, something which was integrated and cohesive and reflected more modern thinking and accounting standards. So that was the rationale why we moved to it, even though we had an established set of standards, that it gave us something more up-to-date and integrated and streamlined.
Thank you. Well, now, I think we can probably conclude, not because we are concluding, but to draw a first conclusion, that at least we can all agree on the fact that we want useful accounts produced. Then we probably do not agree totally on who is the right user or the exact user for that set of accounts. But for sure, we all want good accounting for private companies to deliver information to whom they need. So the base is safe. It's not immediate to give the right answer, especially when legislators are taking over, so they're taking decisions. So free from legislators, probably we could, in terms of best practice, reach a more comfortable or a much easier result. But the fact that we agree on the point that the financial reporting has to be useful, this should help us to see and to at least update our way forward, having an eye on usefulness. So, because preparers have to deliver services to the clients, and the clients themselves, they have to rely on a platform that at the end produces something that is adding value to those who are using them. So this is something we can all agree upon, I think, easily. Now, said that, I'd like to raise a sort of additional point on financial reporting, and talking to a standard setter, I know I'm entering into a very difficult path, but I do it as a private person, as an accountant, so I may dare not to be precise in addressing the question, but I like to know what a standard setter can think about. My personal vision on the accounts produced by a company is that, as we were saying before, they should be useful for others to understand what the company is doing. We give as an assumption that the company is producing accounts for itself and the managers have to understand what they are doing. We give it as an assumption. We are talking about general purpose financial statement, or at least to the existence of people interested in understanding what the company is doing. Now, I have always thought that the accounts are the starting point for the understanding of what and where the company is going. So I have made up my mind, or I have invented a terminology regarding accounting that I call forward-looking accounting, which is something that is starting from what I've produced. I like to use them to go further. And I think that in the SME sector, this is absolutely useful because very often the SMEs have internal difficulties in projecting to the future the past results, or even to be able to understand what they will be doing in a couple of years. Now, you may say this is not financial reporting. This is nothing there is no connection with historical financial reporting. So it's not in the standard setter agenda. But I like to put the question on all of you, how you say it. Don't we think that there should be a way to consider the past and the future connected in terms of the kind of information I deliver? Even under a standard setting point of view, could it be possible tomorrow to have an agreed upon procedure based on the fact that when you produce your final account, then you also produce a number of information, additional information based on what you have published, that give to the public an understanding on what's going on, which is a way to say, is it possible to produce a standard on the going concern?
So in my past life, I was a banker and operating in a bank environment, and I think Peter touched on this as well. Whenever you look at a company's set of results, you look both at their history of what has happened, at the financial statements they actually have, and then one of the first things you ask them for is their budgets, their forecasts, their projections of what they think are going to come from the future. I think that there is an awful lot of useful information that's controlled or contained in budgets and forecasts. The difference is, and perhaps Andrew, when he picks up at the end of this discussion, can answer this one, the ability to verify information that has happened in the past, information that has actually occurred, gives that information a special kind of value, a special kind of clarity, a special kind of information content. And whenever we speak to users of financial statements, they tell us that verification process is a very, very useful qualifier on the information they're receiving. And so what you end up with is you end up with two types of information. The information that's looking back, that is verifiable, that can actually be identified, that is shown to prove something, and then some type of framework for information that looks forward, and some type of process that's perhaps not as strong, not as sound in the verification space, that allows you to sort of evaluate that information and determine whether or not it's accurate. When we speak to users, a lot of the time users tell us, and we see this particularly in projects like the insurance project, a lot of users tell us that they would prefer to have the building blocks of that look-forward process so they can add their own assumptions to it to see whether or not they come out at reasonable numbers. So if I'm saying I think my sales are going to grow by 10%, they want to know the 10% so they can adjust it to 5% or 15% if they think it's realistic. From an ISB perspective, or from a standard setter perspective, we certainly will continue to focus on this historic information, on the information that is verifiable. But what we do is that we work with other bodies. Integrated reporting is one element that plays in this space. Work with other bodies who are trying to develop more forward-looking tools. And ideally, a set of financial statements at some point in the future will contain, in very separate compartments, this look-back data, this information that is verifiable, that's on a consistent basis, and then some forward-looking element that you can actually pair with that has at least some of the same basic building blocks, but allows the user to understand management's view of what they think is coming. And sometimes that's in management commentary, that may be in some other aspect of the financial results, but I think it is necessary.
Federico, I think it's a great question, and I'm going to take it outside of the the tradition of the annual financial report, because when we start talking about forward-looking, what we're really talking about is being able to manage to the data, I think, and I think more so than the users and what reliability they'd have on future data. How can the company, how can that business owner use now the financial data and for it to be relevant? And we see a lot of our small practitioners who are entering into more of everything that's old is new again. They are back into what used to be called write-up services, but in a much mature way today versus where they were in the past. So they, through technology, and our subsidiary, CPA.com, has actually gone out and focused on the best of the best breeds of technology companies that we can help CPAs use with their clients to help their clients be better, so that on a monthly basis they can look at their KPIs, they can look at cash flow information, and now it becomes more relevant the type of services that the CPA, the accountant, is providing to the user. And they could do better forecasting, actually, because now they're into the KPIs and they're seeing it, and they can adjust based on having real-time data to what it is. I mean, the annual financial statement is fine for compliance purposes and for those users who may want it, but it's not particularly relevant or useful for a company to make business decisions. They can't take a financial statement of information that is 3 months old and make decisions. It's going to be a challenge for them to do it because a lot can happen in those 3 months. So now getting into real-time data and giving the accountants, and I think where we're seeing how we interact with our clients in the SME space is changing drastically by the day. And it's exciting because now bringing that accountant right in as that business advisor, we use the term trusted business advisor. We want to see our members working more with their clients and helping them to manage, because that small business can't afford to have, you know, the CFO panel that we had this morning of all the great CGMAs, the CIMAs that were up there. That smallest, that micro entity, though, still needs that type of help. And that's where we even see like our sole practitioners getting the CGMA, understanding they are doing management accounting for their clients, right? But they're doing it for a lot of them. And that's the type of financial reporting that I think is going to be most relevant for the SMP to provide to the SME.
What's your view, Peter?
I think probably one of the most important aspects of this, I think you've already raised, and that is the relevance of this material. If you look at what really happens in the real world, and I know we all are doing that, but if it's a listed company, the most important information that anyone gets who's an arm's length shareholder from a listed company is the releases to the stock exchange. They have to be released, very tight time frames, lots of information around profit projections looking forward. Those things are eagerly watched and eagerly waited upon, and they can change pricing. If you go to the SME market, or let's just go to the annual report. Annual accounts are usually filed. Annual accounts are usually filed a couple of months after year end. So, in one context, it's akin to bayoneting the wounded. You know, it's history. It's there presented, but it's really history. It doesn't give you a lot of information. So, if you ask most people, I suspect, when they open up a set of annual accounts, what's the first thing they look at? People in this room might be different, but most users will go to a well-prepared, well-credentialed director's report to read what is actually happening to the company. So instead of using the accounts to inform the director's report, I would suggest most people go to the director's report and then go to the accounts for the detail. So The system is evolving to provide the information to users about how a business is progressing, but I'm not sure the reliance on accounts, in spite of all the work we do, I'm not sure the reliance on accounts is becoming more. In fact, I'd even suggest it's becoming a little less.
Thank you, Peter. And you.
I'm trying to be difficult, so.
It's a very interesting point on reading the director's report before the financial statements, because when I get a set of draft statements in for review before they go out to the market, that's exactly what I do. Because I want to know what the directors think they were doing. And then I'll look and see whether I think the numbers reflect what they think they were doing. Going back to the question of the link between forecasts and historical data, I agree very much that there's always a need for forecast information to be improved. Even in large listed companies, forecast information can sometimes not be of the quality you would like. When you get into private companies, it becomes quite difficult, partly because many people who are running private companies aren't necessarily the best at doing financial reports. They're much better at running the business and generating wealth from it. Where I think historic data comes in is that it provides absolutely essential confirmatory evidence of what has happened. And what that then permits you to do is compare what's actually happened with what the directors thought was going to happen. Going back into the listed space, I could be a little cruel and say that the best improvement to financial reporting might be for the directors to have to publish last year's budget and then variances between that budget and the actual numbers for the year. But that might give a few problems in some jurisdictions with forward-looking information. But it is that linkage. It's the balance between what we thought would happen and what has happened. It's what the banks look at when they've lent money, when they're looking at companies heading into financial difficulty and considering whether they need to get more detailed information. The reasons they want more detailed forward-looking information is that they're getting worried, so they want monthly numbers rather than 3-monthly. So it comes back to the question of, yes, we need better quality forecasts, but we also very much need that ability to confirm what those forecasts said.
Fantastic. So before we move to the question and answer session, I'd like to ask the ladies who brought me the iPad. I'm sorry, I lost the, I didn't know what I touched, but I lost the page where there was the question. Is there anybody that can help me to rescue?
iPad help.
Can you help me to rescue the page? Because I touched the iPad and I lost the, sorry for that. But just to conclude this part, and thanks for your contribution on this specific point. There are a couple of elements that are already in place regarding forward-looking accounting. The going concern, which is something unwritten from the standard setting point of view, but written with regard to the auditor activity. So which seems to me a bit inconsistent because we have been facing with IASB the update of the auditor reporting with a lot of demands on the auditor reporting on this and that because investors were dissatisfied. And in the discussion how the key AM project, what else to report in the auditor. Thank you. No, l'ho perso la pagina.
Perhaps I can talk about going concern for a minute from the IASB perspective.
Yeah, this could because so we have. Thank you. We have this a little paradox where the auditor is supposed to be able to produce a statement on going concern, but there is no standard setter. There is no standard on the going concern. And another point that is linking part to the future is any impairment test is based on the cash generating units or whatever technique. So we're not talking about something that is so outside the standard setting philosophy.
I think you're absolutely right. I think both full IFRS and IFRS for SMEs require that you prepare the financial statements on the assumption of going concern. That's a requirement. So that's certainly in the standards and definitely part of the standard setting realm. The difficulty comes in defining what is a going concern. And the ISB received a request a couple of years ago received a request at around about the same time that the International Audit Standards Board received the same request, which was to try to be more definitive about what going concern meant, to try to be more definitive about when you have and haven't met going concern, and to try to make sure that the disclosures that we proposed around going concern were such that people could better understand how management had arrived at the decisions they had arrived at. In the end, when the ISB looked at this, we believed that we were going into a realm of application guidance, that much of the decision-making that you make around a going concern is very situationally and contextually specific under certain circumstances. And if the ISB tried to actually write rules for going concern, we'd end up potentially in a situation where we'd actually create the wrong type of dividing lines. So we felt it was better to leave that as a principle. I think it's worth saying this was one of those votes at the ISB board table that was a 7-7 vote. And my expectation is based on what's happened over the last couple of months and what the International Audit Board has done, is that this issue is likely to come back to the board at some point in the near future. Simply because although I think many people agreed with us, this is not a space for rules, this is a space for principles, people felt that there was room for further guidance from the ISB.
Right, thank you. So if you all agree, I would like to open up for questions from the audience. We have received one written question to the system here, and then we'll see if there are other questions coming up. The question we received is not specifically addressed to any one of you, but I think, Darrell, you may want to be the first answering. The question is, why should we adopt IFRS when it involves a lot of write-off of unrealized exchange losses impacted on the profit and loss of SMEs?
Okay, so I imagine that question is in the context of purely of SMEs and not looking at the full IFRS environment. I think certainly, as we've discussed, I think at length here, adopting IFRS for SMEs will result in changes in your accounting practice almost certainly relative to what you have previously done. The view we would generally have in all but one space, and I'll come back, or one or two spaces, and I'll come back to those in a moment, is that IFRS for SMEs does produce an economic view of your financial statements. And importantly, it produces a consistent economic view of your financial statements with those of others. If you're adopting if your previous accounting standards that you used allowed you to recognize certain assets, say for goodwill or for internally developed goodwill or for internally developed brands, IFRS for SMEs doesn't allow that, and you will end up writing down your assets. You will end up creating additional costs that you haven't previously recognized. There's nothing in the IFRS for SME standard that stops you from disclosing that information, from providing that information to your users of your financial statements, even for prominently providing that information to the users of financial statements. So the primary benefit here is to get you on a consistent economic basis with everybody and then allow you to bring in the additional information that you believe is relevant to understanding your financials and present that as part of the overall. Biggest advantage, the consistency across the board for reporting in multiple jurisdictions.
Right. Are there any other comments from your side with regard to the same issue? No? Peter?
No, not really, other than I guess the point that if the person asking the question believes that their accounts aren't representing a true and fair view, to use the old language, they shouldn't be compelled to adopt standards. Having to adopt them, then explain elsewhere why they're not really applicable is a funny sort of way of handling I know that's how it happens at the moment, but it does seem an anomalous result to me.
Mm-hmm. Right. So do we have other questions from people in the audience? We still have a couple of minutes.
One over there.
Can we help? I have the light in my eyes, so into my eyes.
Can I?
There you go.
I'm at the microphone.
Okay.
Over there, yep.
Yeah. So I'm Arjuna Herat from the Institute of Chartered Accountants of Sri Lanka. First of all, congratulations to the moderator and the panel for an excellent discussion. There was a lot of value to take home. My observation and the question is on the basis of the concept of limited liability. The legal framework of a country sort of gives business a limited liability and benefits of limited liability. And from a macroeconomic perspective, there's a certain amount of obligation that the business brings to society. And also, if you really see the SME sector contributes, sort of in terms of employment, is quite large. In terms of GDP contribution, possibly is not so large. And the aspirations and the vision of a country is to get this SME sector contributing to a larger extent to the economy. In this framework, we as a profession of accounting, similar to doctors, would like, I think there's an obligation to prescribe and facilitate this process of getting SMEs to contribute to the economic development and the society at large and to fulfill the obligations. In that context, the debate was whether there is a need for a standard, small enterprises and SMEs. And I would like to hear the observations of the panel as to, from that context, isn't it important to actually have a framework for small enterprises, given the limited liability concept and the obligations that this business has to society and from a macroeconomic perspective? Thank you.
I think it's a very good point. I think it's a very well made point, and I think Andrew, to a certain extent, touched on it earlier as well. When we were talking as a panel here, I think everybody saw a place for the standardized financial reporting for companies. We just found it quite difficult to identify which companies should be actually falling within a framework. And I would support that. I think you're right in saying that the framework needs to apply, and there are certain circumstances. Limited liability is certainly one driver. The fact that you have or need to get financing, you need to get investors to run a small company, suggests that you need a common framework. But I think each jurisdiction is best placed then to decide who should apply that framework. And I think it's the point you're making is knowing your particular jurisdiction, knowing the circumstances of your particular jurisdiction, you are best placed to know which companies are benefiting from that limited liability and therefore should be applying the framework. There may be other small companies, there may be mom and pop stores, there may be partnerships who don't have limited liability and therefore appropriately don't have to apply SMEs. But I think it's best left to jurisdictions to make the call of who should be applying a framework.
Yeah, I agree with Daryl. And I think what we're seeing from a marketplace perspective, I think it goes back to this concept of statutory audit or, statutory reporting that happens with many countries, that you're seeing that relaxed more and more each day, that there are fewer countries who are mandating that. So relieving some of the reporting burdens of small companies. In the U.S., we are a small business-driven society. To mandate that there's some obligation that they must have to report their financial reporting outside of the tax system, I don't believe makes a lot of sense. I don't think it's something that we would necessarily see. There's this concept of integrated reporting. We've danced around the topic a little bit here today, and I'm sure it's somewhere else on the agenda. So do you then mandate some type of an integrated report so that society can see where a company is going from a human capital perspective, from all sustainability, all of these other things outside of just the historical financial statements? And we have just not seen any uptake in that in the listed entities, let alone in the private companies. But we are seeing elements of certain suppliers, creditor relationships where they're asking for sustainability-related information, not necessarily historical financial statements, but sustainability and some element of integrated reporting. But again, that's really currently the minority, and we'll see if it really gets the uptake that people are predicting.
Yes. Are there other questions from the audience? If so, please, yes, for sure. Could you please make a question, because
There's somebody over there with
Yeah,
the mic
I
first,
know.
to the right, with the mic, and then...
May I, to allow us to pick up maybe one more question, may I kindly ask you to address one specific speaker if you can, and to make a question directly, please.
Okay, thank you. My name is Nkiru Kamokelo from ICANN, Nigeria. I would just like to know the advice to companies that on conversion, they find themselves in a more profitable situation. In the prior year, they had already paid tax on. And the tax law in that country doesn't recognize the fact that the profit, additional profit, has nothing to do with actual growth, and they are likely to charge them to tax for the additional profit that emanated from the conversion to IFRS. Thank you.
So many jurisdictions have struggled with exactly this problem, which is how they adjust their tax law to reflect the change in tax accounting. And there are a number of solutions out there. I've had the good fortune to have spoken to a couple of people from the Nigerian Tax Authority on how they might deal with this conversion. And what I perhaps suggest is we pick this up in tea time, because I'm going to be in Nigeria in a week's time to discuss almost exactly the issue there too. So if we can pick it up there, I think that's probably the easiest. But it is about the tax authorities realizing they have a different objective to the financial authorities and adjusting their systems for that process.
And did you want to comment?
Yeah, just on that point, this is an issue that we have needed to deal with both on the transition of listed companies to IFRS and also as we look forward to the transition onto new UK GAAP. The way that our tax authorities have dealt with it is that they have acknowledged that there may be a change, as has been illustrated, on the adoption of the new standard. It may be positive, it may be negative. And the solution which has been followed there is to amortize that change over a period of years. And what that means is that in overall and broad terms, the tax authority doesn't suffer too much, but more importantly, the individual companies don't either.
Thank you. So we have one question more? Okay. So we get last two questions, and then we have to close.
Good morning, Hernan Casinelli from Argentina. I have three specific questions about
Three
but
questions.
very, three only.
Three.
But about the comprehensive review of the IFRS for SME. Recently, we knew that the ISB tentative decided to add the revaluation model in the IFRS for SMEs. The question are why the changes, and if it suppose a new idea for request information about other issues related with this change. Thank you.
The exposure draft that we issued on IFRS for SMEs had some very strong feedback that this was a necessary and very simple addition to the accounting standard as it stands at the moment. And so our response now is in response to what we've heard from our constituents. That would mean that we don't need to re-expose because we're simply addressing what people have told us in the space. It does go against the original idea that we want to keep options as limited as possible, but we heard a fairly consistent message that people felt this one option was worth it.
So the last question now from the audience?
Federico, you do have one over here.
Sorry?
We have to,
Yeah, sorry.
Have you?
Yeah, this is Ibrahim from Turkey. I have a little question for you. There are three standards: IFRS, US GAAP, and UK GAAPs. Am I right? What is the differences between them, and what is the result of them for the financial statements? The second question.
Well, the first one, it may imply an hour of discussion, the first
The
one.
second question, about taxation. And as you know, the financial statement provide, let's say, IFRS or US GAAP. But all the countries want to get a tax. And how can
calculated tax, which financial statement, let's say profit, and because profit and loss statements will be differences. How can they collect the tax from the companies, etc.? Thank you. Did you understand my question? Oh.
Do we have the time to answer?
Okay.
We could probably take it offline. We can do it after. Maybe we'll take it offline and talk about the differences. And there are more gaps than just the two gaps here and IFRS. There are plenty of other financial reporting out there, so that answers that question pretty quickly. This gentleman here had his hand raised for a while, so.
Yes, unfortunately, we need then to close because I suppose there will be lunch for everybody, so I don't want to impede anybody to have their time. One quick one. So the last question, please. Go.
Okay, my name is Yemi Sani, a member of the Institute of Chartered Accountants of Nigeria. My question goes to the standard setter. And
you are starting there, huh?
Yeah, basically, from the discussions we have had here, the basis of the IFRS for SMEs is majorly to have uniformity. And we've talked about the cost and the relevance of having a unified framework for SMEs. My question is this. While coming up with this framework, the standard setter, from my own point of view, they introduced the framework with a big bang, as in for Africa, for example. I want to talk about Africa, for example, because
we are running out of time.
Yeah,
so
no.
Get to the question.
I'm going straight to the point.
All right.
So the point is that I want to know what steps were taken in coming up with this framework, whether each regions, because you just mentioned that in UK, in US, you have about 14,000 listed companies, about 29 million SMEs. We don't have that kind of statistics. I'm asking what steps were taken, right, in looking at the developed countries and their peculiarities in setting up this standard, this framework, which you want them to adopt at this time, looking at the fact that, looking at the cost and the relevance of this framework to the SMEs in those developed world. Thank you.
So we spent 10 years developing the IFRS for SMEs, but we spent a lot of time visiting countries, and I particularly spent a lot of time visiting countries in Africa, speaking to the two countries in Africa. I am African myself, speaking to those countries about the specific issues, concerns, and problems that they have with IFRS for SMEs. And a part of the current process we've gone through in making some adjustments, and Hanan asked the question about re-evaluation of property, plant, and equipment, is directly as a consequence of issues raised by developing economies. Developing economies have addressed the fact that they have more inflationary environments, they have faster growth in values of property, plant, and equipment, and therefore want to address that. So we are picking up directly those issues. But it's also why we visit the countries. So as I said earlier, I'll be in Nigeria in a week's time. It's why we go there so that we can continue to hear those messages and talk to the constituents. And
Thank you. So I think we need to close. I'd like to thank a lot Darius Scott, Mark Hosiel, Peter Dowling, and Andrew Buchanan. You have provided us with a very good insight. That's very good. I hope you enjoyed the session and enjoy your lunch now. Thank you very much.